Okay, well, let's talk about currencies and stocks. I think many of you know that the Canadian dollar lost plenty of ground against the American currency from the fall into early this year. But now a lot of people are wondering whether or not the U.S. dollar strength is waning, and could that be a help to the TSX overall? Ian Verteuil is head of portfolio strategy at CIBC Capital Markets, and he joins us here in studio. Ian, it's nice to see you. First of all, when we're thinking about companies that make up the TSX, how important is the trading relationship between the U.S. dollar and the Canadian dollar, would you say?
So, in a lot of ways, the TSX is a reflection of the Canadian economy. Canada's a trading nation, and the companies that make up the TSX have a lot of international businesses. You'd really only say that maybe 40 to 50% of the revenues of the TSX are actually within Canada. And you're absolutely right, the US is the biggest part of that. Probably about 25 to 30% of the revenues actually come directly from the US. But as well, Europe and the UK are extremely important. So those would be the main regions that really make up that. So when the Canadian dollar weakens, you and I are less wealthy, consumers are less wealthy, our buying power goes down. But for most of the companies on the TSX, they actually get a little bit of a headwind because they're translating their earnings in foreign currencies back into more Canadian dollars because the dollar is weaker.
And so what do you think, generally, what's the team at CIBC predicting when it comes to what happens with that currency relationship from here?
Sure. So as we think about the Canadian-US dollar, we don't expect a lot of further weakening, but we don't expect a lot of strengthening. As you rightly said, from the fall right through to the start of the year, we really saw the Canadian dollar decline on a vis-a-vis the US dollar from about 74, 75 cents to below 70 cents. So that we would expect maybe the Canadian dollar probably has experienced the worst of its weakness, and that's simply because what we're starting to see is exactly as you mentioned, we're starting to see the U.S. show signs of weakness. So you mentioned consumer confidence in the United States starting to wane a little bit. So that exceptionalism that really set the U.S. market apart, I think, is starting to wane a little bit as we move forward.
And then just to further put the pieces together, if you're not expecting to see as dramatic a move between the two currencies, but some Canadian companies had benefited from a weaker Canadian dollar, what do you think that means for the profit picture going forward?
So the reality is currency moves day to day and they're instantaneous. In terms of company reporting, it takes a period of time. So in Q1 and Q2, and we've seen neither of those reported as yet, in Q1 and Q2, we're really looking at 6-7% tailwinds in all their international business. And even if the loonie stays where it is vis-a-vis the US dollar and against sterling and against euro, we would see that continue on for most of the year.
So just the fact that it weakened and it's where it's at now, it's the math of that level which benefits those companies.
And as well, one of the things we're starting to see here is a US dollar that is starting to weaken against other countries as well. So typically when the US dollar is weak, the Canadian dollar is strong. What's actually happening is the Canadian dollar weakened first, and now the US dollar is starting to weaken, but it's really pulling the Canadian dollar down with it. So we're seeing Canadian competitiveness vis-a-vis the euro and UK actually start to improve. And we have a number of companies that actually get the benefits of those things.
Now, the other thing that I guess people like to try to determine as influencing the loonie would be things like interest rates. And there still are expectations after the rate cuts we've seen in Canada that there might be more action lower by the Bank of Canada. How does that impact, you think, the Canadian dollar at this point?
For sure. Interest rate differentials are an important element, simply because if you can clip higher coupons on owning US dollars versus Canadian dollars, that puts pressure on it. So we do expect more rate cuts, I think, over the course of this year. But what we're also seeing is a US economy that is not doing as well as individuals would like. I would want to mention, though, another one of the key variables that has helped the TSX and probably will continue to help the TSX is the strength in gold prices. The TSX has become the de facto home of gold companies anywhere in the world. If you are a gold investor, you have to invest in companies in the TSX. There are a handful of others in other places, there's one in the S&P 500, there's a couple in South Africa, but really the big gold companies in the world, if you want to invest in anything other than bullion, and you want to invest in companies that have leverage to that, you pretty much are going to be looking at the TSX.
Okay, so I want to put three things together. First of all, the TSX has gold exposure. Second of all, a weaker Canadian dollar might help performance for some of the stocks listed on the TSX. And third, if interest rates in this country continue to go down, I would imagine that might increase the appeal of some of the dividend plays in Toronto. Does this mean you're generally constructive on the Canadian stock market?
Yeah, you put all three together for me. I think my reports run pages and pages. You've done it for me in seconds. I do think you're absolutely right. Weakness in the Canadian dollar, strength of gold. And the last part I would say is just to embellish on your point on declining interest rates. We have seen a significant buildup in fixed deposit books, the GIC books on Canadian bank balance sheets. And most of those are relatively short dated. Most of them are 1 year or less GICs in terms of maturity left on them. As those rates come down, that money becomes mobile because old guys like myself that bought GICs yielding 5%, they start to look for other alternatives. And as you rightly say, the dividend-paying stocks in the TSX fit that bill pretty well.
Interesting. So because interest rates had been higher, people were parking money in GICs. But as those products mature, you think that a good amount of that capital could just flow into the TSX because of the dynamics you highlighted.
If we were getting 5%, we're now getting 2.5%.
Yeah,
At 5% risk-free money, even old guys like myself that are they're becoming a little bit senile, realize that's a great investment.
Young at heart,
Young
Mr.
at heart.
Verteuil. Great to see you. Appreciate the breakdown. As always, Ian Verteuil, Head of Portfolio Strategy at CIBC Capital.